Hello, everyone. Welcome to another episode of the PowerTalk Show powered by Business Talks Weekly. Our guest today is a very inspiring real estate mogul. He is the founder of SCP Capital, Daniel Paloscio. Daniel, welcome to the PowerTalk Show.
I appreciate you having me on, Nav, and I'm excited to do the show.
Thank you, Daniel. Can you tell us a bit about your professional journey and how did you land founding SCP Capital?
Sure. So my professional journey started at about 2012. I picked up a book called a book by Jay Scott called The Book on Flipping Houses. It was a BiggerPockets publication. I learned about real estate, flipping houses, and I also learned about BiggerPockets. That took me to the BiggerPockets forum, which is where I learned a tremendous about all of the different, classes, I guess, of investing in real estate: wholesaling, fix and flip, commercial. And in 2013, I bought my first investment property. It was a fix and flip in my hometown, and turned out to be the deal we've ever done, the highest return. But that started my career in fix and flip in about 2013, and I did that for a number of years and borrowed a lot of hard money from local private hard money lenders. And over the course of my career, I did some wholesaling. I was buying and holding rental properties, and so I got exposed to different classes of real estate, different models. And what I really liked was I liked that my hard money lenders were in some cases making just as much or more money than me on deals, and they didn't leave their office. A lot of times they were funding my deals from cruise ships and so in 2017, I did my first loan. I'd saved up enough money from my fix and flips. I lent out a couple $100,000 to another fix and flip investor. I understood that asset class, and I felt comfortable lending on those types of properties. And I did my first loan. I did another loan after that, and then I was tapped out. And I was sort of just figuring out how I was going to put deals together and keep it going. I sort of just did it as a side project while real estate was still my full-time focus. And I had the idea to just reach out to one of my old hard money lenders. I asked if they'd be interested in investing in notes with me. And so for a while, I would originate a loan with my capital, and I would assign that note to my investor so that I could free up my funds. And I kept that going for a number of years. Then in about 2019, during COVID, I live in Florida. And so I was a partner of a vacation rental management company, and I own several vacation rentals. And we were just at the right place at the right time. We ended up having the best year we'd ever had. And I had more cash in my bank account than I would have liked to have had, and nothing to put it into. And I just had this bright idea. Well, back up. I had this bright idea because I had done 1099s earlier in that year, and I realized that some of my capital investors were making more money than I was making just through their passive earning of interest. And I said, well, I need to get more of my money into our loans versus assigning them out. And so about 2019, I started investing my money into all of our notes. I now invest in all of our notes alongside our investors. I believe I'm the largest investor in the portfolio this time. And so I've grown it from there. And about 2023, I decided to do this full time. I sold majority interest in the vacation rental management company to my old partner, and I dove in on this hard money lending full time, and I've been growing the business since then.
That's very interesting journey, Daniel. Daniel, with SCP Capital, what challenges did you see that you thought like you will be able to solve with SCP Capital for your clients?
So lending, there are two types of hard money lenders, you could say. You have institutional hard money lenders like the big Wall Street funds like Kiavi, Lima One Capital. Those are the big institutional lenders. They've recently turned the space into a very institutional, almost conforming loan product, right? Its application and qualification is cumbersome. This business was originally set to be an asset-based lending model. And so we look at, so to say, the horse more than the jockey, right? We care about the property more than we care about the borrower. And so the weighted average of our portfolio is about 50% LTV. And so for us, it's just getting on good deals. And so what I saw in the market was that the institutionalization of hard money lending was making getting loans cumbersome. And I wanted to sort of get back to what hard money lending is supposed to be. It's supposed to be quick, easy access to capital in safe, low loan to value deals. And so there was a need for that. I think a big underserved sector in the hard money space is business owners. A lot of people chase fix and flip investors, rental property investors, but there is a huge market of business owners, people that have widget factories and they own their factory free and clear, or they own their rental property or two free and clear. And they just need sometimes access to that capital so that they can invest and buy widgets and so that they can make a purchase order and then they'll usually that comes full cycle and they pay off after. And what I also found about that market is that they were a little bit less fee sensitive because their alternatives are merchant cash advances and other business financing alternatives that are frankly very, very expensive. And so I found a niche serving the business community in private lending.
That's very interesting. And Daniel, every financial institution or instrument goes through a lot of security and regulations. How are you managing your clients and end users' capital, and what kind of regulations and security measures have you put into place?
So, as I mentioned, probably the metric that we track most and the metric that I obsess about is what is our loan to value, right? And so we ensure that we're safe in the loans that we do by keeping that loan to value low. We will go up to 65% LTV for some of our clients, depending on the situation. But by and large, like I mentioned, the weighted average of our portfolio as it sits today is about 51% LTVs. The security that we all get from that is that there could be a lot of movement in the market before we're in a situation where we've got negative equity. I think in the history of the American housing market that's probably happened twice: 1930, Great Depression, and 2008, the Great Recession. Even outside of that, if we were to have to take an asset back during one of these black swan events, we're essentially buying at the bottom. If we're at 50% LTV, by the time we take that property back, let's say we've lost 50%, we're, in the asset for 100% of asset value, but at the bottom of the market. And if you have to, because of my background in real estate, we'll, determine whether that property needs to be fixed up, rented out, and then we'll hold on to it and wait and rent it out and wait for the market to increase. In terms of regulation, there's not a ton of so there's two ways to do this business, and I do it on what's called the direct placement model. And so we work with investors on a per loan basis through participation agreements. They have an opportunity to participate in specific loans. Early January or late January, early February, we'll be transitioning to a 506c a debt fund, and we'll be under the purview of the SEC at that point.
Wow, that's very interesting, and all the best for that. So, Daniel, there's technology apps, there are platforms currently which allow you to purchase a private or a commercial property on a fraction basis and then, invest some amount of money and get good returns. In Dubai, there are platforms like Stake, which allows you to actually invest to a fraction amount of monthly or yearly money you can pocket, and then whenever the prop you can actually sell it and you can get your investments back with a good amount of profit. So what's your take on that? How do you see such platforms evolving and coming into the market?
I think we have similar platforms to that in the States as well. Many of them are working on larger projects for bigger developers. We tend to focus on majority investment residential properties, and we do some small balance commercial. I like investment residential one because that is where I cut my teeth in this industry. I understand that product. I understand that asset class. I like that those assets are easily tradable. I like that they're worth what other homes around them are worth. It's a little bit more clean. Our investors, I think that they can look at that asset, understand what that asset's worth. They can look at the property up on Zillow or Realtor.com. They can look at our due diligence, and they understand the asset class as well. So I do see that the sort of crowdfunding of the lending model, it makes sense to me. I can see how it could grow a lot here as well.
And what about tokenization? Do you have any do you foresee tokenization to actually build up and scale the real estate and prop tech model?
Yeah, I think it's the natural progression, right? I think that we're a little bit behind on some of these things. Some people are doing them, but it's a much cleaner way to track the chain of title, keeps everybody on the same page. It takes an otherwise sort of large asset and fractionalizes it, which is what we do. So we fund all of our loans with our own capital, and then we sell participations into each note fractionally to our capital investors. And so we create that scenario for our investors manually. And so the tokenization of that is the obvious next step, which automates that process. And it opens you up to, I would say for me as a lending company, it opens us up to a much broader investor pool, right? Because there's so many people that are internationally involved in tokenization of anything. So I think I haven't given it as much thought as I should. And after this conversation, I think that I'm going to have to dig into that because I'd like to be at the forefront of it.
Absolutely. It opens a wider market for your audience as well. So, Daniel, when I was reading your profile, I read you are the flipping expert for real estate. Like, I want you to explain what is actually property flipping to our audience.
Sure. So it again, there's two types of property flipping, and so I've been involved in over 1,000 transactions in my career, whether it be the maker as the maker, the investor, the borrower, or as lender. And so there's two types of flips when people mention flips. There's the like old fashioned fix and flip, where an investor buys a property at a discount below market value. They put in what's called the sweat equity, where they're fixing updating the kitchens and bathrooms and putting in new flooring. They maybe change the roof, and then they sell it on the open market to the highest bidder, and the new buyer gets to move into a brand new home, and the investor makes a spread along the way. So that's sort of the traditional fix and flip model. There's another model, it's called wholesaling, and essentially they're just flipping paper. And so I founded another company. It's doubleclose.com. We're the nation's largest transactional funder. And so what we do in that company is a wholesaler basically finds a really great deal, right? Maybe the property is worth, easy numbers, it's worth $100,000 as is. They get that property under contract for $60,000. Then what they do is they find an investor who's going to do the fix and flip. They sell it to that investor for $70,000. They make a $10,000 spread. The investor then goes and puts money into that property to increase the value, and then they sell it for $200,000 or $150,000, right? And so those wholesalers, a lot of times they need money to buy the property so they can and then turn around and sell it to the fix and flip investor. All of this happens on the same day. The purchase and the sale happens on the same day. So it's a little bit of a it's a little bit of a dog and pony show to get everyone lined up, right? And so we'll essentially fund that transaction for a lot of times a few hours, and we provide liquidity for the wholesaler so that they can just sell their property. And so and that would be the other way. So you've got wholesalers who flip paper, and then you have fix and flip investors who flip actual assets.
That's very interesting way of doing business. Daniel, I want to keep your investor and finance guy aside. I want to talk to you as an entrepreneur. You are building two companies, two brands side by side. What's your take? What are your challenges you have faced so far in building this company from scratch?
So, my challenge so far has been I've never had a problem doing the work. It's something that I've always been passionate about. I think to my detriment. I think I do a little bit too much, and I'm learning how to bring in people that are better than me at specific things and bring in specialists to specialize. And so it's been a learning curve for me in terms of managing people and managing process versus seeing something that needs to get done and just doing it. And so as we've been building out our team, we've relied a lot on, we use the culture index, which is a predictive index, sort of a personality index, which helps us align people in the right role. And that's been really helpful for us in terms of finding someone that is going to be around longer term, is going to be a match for what they're doing. And leading that team and developing those systems and processes. That's sort of what we're working on. I've built out a great sales team. And so we're at an inflection point here where we're selling more deals. We're originating more loans than we actually have capital to fund. And so a lot of the loans that we're originating now, we're sort of brokering out to other private lenders. So going into 2026, after the fund is established, we're looking to bring on new capital investors so that so that we can keep those loans in house, which is first and foremost what we want to do. We're a balance sheet lender, and so that's been a choke point for us. But it's been a choke point because I've not focused on the capital raise. The capital raise has sort of been on autopilot up until now, and now that the team has been built out on the sales side, I'm going to have to focus more time and energy on bringing in accredited investors.
That's very interesting. So in that case, if I ask you, what's your vision for the next 5 years or 6 years? What would you say?
So currently we're at about a $25 million loans under management. And we'd like to, once moving into the debt fund, we'd like to grow this to about 150 to 200 million. And we just want to manage it from there.
Wow, that's amazing. Good luck with that. One final question to you, Daniel. Like, you are an investor and finance guy. What's the best finance advice you got?
The best finance advice I got. Well, the best finance advice I've really ever received is real estate finance advice, and it's you make all your money going into a deal, not coming out of it. And so what that means is doesn't matter. What's most important is that you buy for less than what the property is worth. I make a loan for less than what the property is worth, because if you make the wrong buying decision, you can't sell your way out of it.
Absolutely. And how, so I just want to extend this. How does one make sure he's buying the right property?
It's due diligence, right? Single family is really easy to underwrite. And so if you have a property and it's 2,000 square feet and it's in a neighborhood with other homes that look like it and are around 2,000 square feet, if all of those other homes are selling for 500,000, you're probably getting a good deal if you're buying yours for 400,000 or less. But if you're buying your property for 505,000, you may have a hard time selling that. And you also need to pay attention to what the market's doing. I think that right now we're in the States, we're in a little bit of a correction. And so the market's a little bit frothy. And so we've recognized that. And what we've done to adjust is we have gotten tighter on our underwriting guidelines. We're doing a little bit less loan to value, a little bit more qualified borrowers. We really want to see that they have an exit strategy and that they can fund the payments every month. You know, what's nice about the real estate market is that the real estate market turns a lot more slowly than equities, than stocks, right? And so, like, the perfect example is in the market crash in the States of 2008. You had the stock market really decline for about 6 months or so, but by 2009 it was already going back up, right? But with real estate, you had the crash in 2008, and we didn't reach the bottom in real estate until about 2012. And so, what that allows real estate investors and lenders to do is to adjust. And when you see that in the market, when you see properties sitting around a little bit longer, when you see price cuts, just pay a little bit less and account for the market going down. So I think since 2012, there's a lot of people that have gotten in this space that only know a bull market. They've never seen anything else. A lot of the newer investors, and so it's important to understand that real estate doesn't only go up and stocks don't only go up.
Absolutely. That's a great point of view. Thank you so much, Daniel. Thank you so much for sharing such an insightful conversation with us. And it was wonderful to have you on our podcast.
Thanks, David. I appreciate being here. I had a great time.